The fourth quarter of FY25, traditionally a peak season for credit expansion, delivered a surprising shift in the Indian banking landscape. Retail loan growth, a key engine of the sector's post-pandemic momentum, witnessed a broad-based and sharp deceleration. For both large and mid-sized lenders, the slowdown marked a reversal from the robust double-digit growth seen in the earlier quarters and the last fiscal year. The data suggests that this wasn't a one-off anomaly, but a result of multiple interlinked pressures. And it wasn't just in Q4. The entire FY25 saw a pronounced slowdown in credit expansion across the banking sector. Overall bank credit growth dropped to 11% in FY25, a steep decline from 20.1% in FY24. The deceleration was even more striking in the retail segment, where the retail credit growth halved to 11.6% year-on-year in FY25 compared to 27.6% in the previous fiscal year. But here's the twist. Even as retail loan growth has slowed, the Bank Nifty recently touched a 52-week high. So what's driving investor optimism? Despite the deceleration, banks have continued to post healthy earnings and operational performance, while more measured remains stable. The sector isn't collapsing. It's simply growing at a cautious pace. Welcome to Bottomline by Groww. In today's episode, we explore what's really slowing down India's banking sector, from falling demands and tighter credit norms to liquidity pressures and rising concerns over asset quality. Will this slowdown weigh on banks' profitability? Could it reshape the lending strategies ahead? And what does it mean for FY26 and beyond? Let's dig in. To begin with, retail lending took a broad-based hit as banks scaled back disbursements, particularly in the unsecured loan segment. This was mainly driven by heightened regulatory scrutiny and the impact of a high base from the previous year, among other reasons. ICICI Bank, one of the country's largest private sector lenders, reported a 9% year-on-year growth in retail loans for Q4 FY25, down sharply from 19% in the same quarter last year. Axis Bank saw an even steeper drop, with growth falling to 7% from 20% year-on-year. IDFC First Bank, which had previously been among the more aggressive lenders in the retail space, posted a 19% growth versus 31% a year ago. RBL Bank's growth nearly halved to 13% from 30%, and Yes Bank actually saw its retail loan book shrink by 3% compared to 16% growth last year. Even for banks that maintained some positive momentum, the pace slowed. For example, Punjab National Bank, Bank of India, IDBI Bank, South Indian Bank, and Bandhan Bank saw their loan growth in Q4 FY25 fall to 8 to 20%, lower than the 12 to 22% logged in the prior quarter. HDFC Bank, which has deliberately been slowing its loan book expansion to better balance its credit-to-deposit ratio, reported a modest pickup in growth from 3% in Q3 to 5.4% in Q4. However, even this improvement is tepid compared to its historical performance. So what's causing the slowdown? This deceleration isn't tied to one or two isolated causes. Instead, it's a combination of both macroeconomic trends and deliberate internal recalibration by banks. Number one, the demand has softened, especially for high-ticket loans like home and vehicle loans. The impact of the slowdown wasn't uniform across loan categories. For instance, ICICI Bank's housing loans still grew at a decent 11% in Q4, but personal and vehicle loans each rose by just 4%. And loans against securities actually shrank by 4% YOY. Interestingly, credit card loans continue to show strength for some, with ICICI Bank's portfolio growing 12%. But Axis Bank reported lower credit card spending compared to the previous year, pointing to uneven consumer behavior. Personal loans, both secured and unsecured, saw their slowest growth in 4 years. Lenders openly admitted to pulling back from unsecured lending. As per ICICI Bank's management, their loan growth had primarily slowed in the unsecured segment due to a shift toward more risk-calibrated growth. A similar sentiment was echoed by Axis Bank's management. Number two, pricing pressure was another significant factor. With intense competition in mortgages and corporate lending, banks were careful not to underprice credit, particularly in anticipation of future rate cuts. This meant maintaining a healthy spread over their benchmarks became a higher priority than chasing volume growth. Additionally, many banks began tightening their credit standards, especially for unsecured loans. The move was part proactive risk management, part response to the regulatory nudges following the post-COVID lending surge that raised flags on underwriting quality. Lenders like Axis Bank have already begun seeing early positive results from such recalibrations. Number 3, asset quality concerns. Asset quality worries started to creep back in, especially in segments like microfinance and small-ticket unsecured loans. These concerns influenced banks' willingness to lend freely. While credit growth has softened, asset quality has come under increased scrutiny. Lending has slowed in parts of the market where stress and delinquencies are beginning to rise, especially among small-ticket borrowers and microfinance clients. Rating agency ICRA highlighted growing concerns around the slippages and potential for worsening asset quality, especially for banks with large unsecured portfolios. The end of an extended benign credit cycle is now making way for a more normalized period where credit costs and slippages are trending higher. Still, the broader view remains cautiously optimistic. CRISIL Ratings expects the gross NPA ratio to stay around 2.4% as of March 2026. So while certain pockets are under stress, system-level asset quality is expected to remain stable. Number 4, tighter liquidity was a notable macro headwind. System liquidity remained in a deficit of 1.5 to 3 trillion rupees during the January to March period, making funds costlier and scarcer. And while the RBI cut rates by 25 basis points early in the quarter, deposit rates stayed elevated due to stiff competition, pressuring margins and forcing banks to rethink their growth strategies. However, a parallel challenge has been sluggish deposit growth, which continues to lag loan growth. System-level deposit growth stood at 10.5% in March 2025, down from the previous 11.5% in the previous quarter. HDFC Bank, for instance, saw an overall deposit growth decelerate to 14.1% from 15.8% sequentially. While that's still ahead of the system average, analysts at Macquarie noted the number was below expectations. The deposit shortfall is not just a liquidity concern. Slower deposit growth can compress margins. The rate cut by the RBI didn't help either. While loan rates tied to external benchmarks fell quickly, deposit rates remained sticky due to the stiff competition. This mismatch intensified margin pressures, especially for small and medium-sized private banks. But not all banks slowed down. Despite the overall slowdown, some banks bucked the trend. AU Small Finance Bank and IDFC First Bank, for instance, ended FY25 with more than 20% growth in both loans and deposits. Their ability to maintain growth while managing risks stood out, and it reflected positively in their stock performance. However, others were less successful. UCO Bank, for example, grew advances by 20% in March 2025, but deposits rose just 10%, excavating the liquidity gap. Kotak Institutional Equities pointed out that while larger banks have outperformed recently, the peak of their earnings cycle might be behind them given the slowing in both loans and deposits and no clear reduction in deposit rates. So what does this tell us about banks performing in the coming quarters? Well, the outlook for FY26 looks cautiously optimistic. CRISIL projects that advances could grow at 12 to 13%, indicating a gradual pickup across segments. Asset quality is expected to remain broadly stable, and there's hope that better liquidity conditions and lower interest rates might provide a lift to credit demand. However, near-term challenges persist. There's no clear trigger for a sharp rebound in loan growth, and net interest margins are likely to remain under pressure as loan repricing outpaces deposit repricing. The timing and extent of transmission of rate cuts to deposit rates remains uncertain, especially with intense competition among banks. Still, the broader narrative remains constructive. Government measures like tax relief and efforts to boost consumption, combined with the improving household incomes, may offer tailwinds to retail credit demand in the medium term. So to sum it up, The March quarter of FY25 and the full year FY25 marked a cooling off period for India's retail lending engine. A mix of internal recalibration, tightening of underwriting norms, and shifting consumer behavior contributed to the slowdown. While FY26 is expected to see a modest recovery, the era of aggressive, unchecked retail lending may be behind us, at least for now. The sector seems more in pause mode than in peril. What do you think? Is this slowdown a healthy correction or a warning sign of deeper stress across the banking system? Leave your thoughts. For more insights, subscribe to Bottomline by Groww.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.